Hello, Kurt Jackson, Retirement Income Strategist with KJ Financial here with this week's installment of Your Money Matters. Hey, I want to ask you all a quick question, okay? Do you believe that there's another financial crisis similar to the one we had in 2007 or 2009 coming at some time on the horizon? Would it surprise you to know that since the year 1900, we've averaged a 47% loss in the market every 11 years? Think about that for a minute, okay? Pick whatever age you are is fine. I'm going to assume, let's just say you're age 50 and you would live to maybe age 88, okay? Wouldn't that mean you could see 3 or maybe even 4 more big drops in the market in your lifetime? So what if 1 or 2 or more of those happened while you were working? What would that do to your retirement? What if 1 or 2 or more happened while you were in retirement? What would that do to your retirement? Would you be living your retirement years on a just-in-case basis, not doing things, not spending money on the grandkids, not traveling, not doing all the things you enjoy just in case you might run out of money? How would that feel to have to live your retirement years in fear of running out of money? All right, can we all agree that another financial crisis is coming? I mean, it just shows us that it's eventually going to happen. When it happens, nobody knows. So the question for you to think about is, do you want what happened to you before to happen again? Do you like losing money? Do you like losing money that you're counting on to give you a paycheck for the rest of your life in retirement? Have you ever asked yourself why we are taught to have that important money, that money that we're depending on for the rest of our life in retirement, to put it in a risky place like the market that's averaged a 47% loss every 11 years since the year 1900? Do you think there's a way to position your money or diversify your money in stocks and bonds that would protect your money? Do you know anyone that had their money in the market, no matter how diversified they were, that didn't lose their collective shirts from October of 2007 through March of 2009, when the market was down as much as 59%? Would it make sense if there was a way to keep you from losing money, that your financial advisor would have positioned you where you wouldn't lose money? I mean, aren't most of them paid on the size of your portfolio, the size of your accounts? So if you had more money, wouldn't they make more money? I mean, isn't that what they tell you? Don't they say, hey, look, I've got a vested interest in you being successful because the more money you have, the more money I make. So that's one of their pitches, that they tell you that they're in your corner, that they're doing right by you. All right. So we've established that you don't want what happened to you last time to happen again. So let me ask you this. This is a little tough question for you. What are you doing differently to make sure it doesn't happen to you again? Have you changed your allocations in stocks and bonds? Are you doing the same thing that you did before? If you're in the market and if you're in bonds, that is the market, then aren't you still at a huge risk of losing when the market goes down? I mean, I think we get a false sense of security that that bonds are somehow safe. Okay, they might be less risky than stocks, but they're not safe. Why haven't you made changes? Has your advisor recommended looking at strategies and financial products that would keep you from losing money? And I'm not talking about putting your money in the bank here. I know your principal is protected for the most part in a bank, but with the minimal interest that they pay, all you're doing in the bank is going broke slowly with certainty. Do you know why? Inflation. The cost of living goes up over time. If it's going up at 3% a year, then every 20 years it costs you twice as much as it did to live 24 years before. If you're earning 0.25% in a bank account and paying taxes on it, are you keeping up with inflation by having your money in the bank? No, you're not. Okay? Has your financial advisor, your retirement plan administrator, your friends, your family, your stockbroker, the media, has anyone introduced you to other ways? So if we can be brutally honest with you here, you really haven't changed what you're doing, have you? Why do you continue to use a strategy that you already know doesn't work? It's proven that it doesn't work. Why would you stick to something that has you hoping nothing bad happens when there might be something out there that has more certainty to protect you? Have you really looked at how huge losses are? Let's say you have $100,000 in the market and it lost 30% in a year. What would the market need to earn to get you back to even? Did you initially think, like most people did, that, hey, I lost 30%, I need 30% to gain, right? And that's what most people think. Heck, sometimes I think that's what stockbrokers and traditional financial planners believe too. But let's do the money math on this, okay? I have $100,000 and I lose 30%. That's $30,000, right? So if I subtract $30,000 from $100,000, that leaves us with a $70,000 balance. You with me so far? So following what many think, all right, let's say we have a 30% gain in year 2, okay? Do we get 30% of the 100,000 or do we get 30% of the 70,000? We don't get 30% of the 100 because we lost 30,000. We only have a $70,000 balance. Well, 3 times 7 is 21. We're talking thousands, right? So let's put 3 zeros on there. So if a 30% gain on 70,000 is 21,000. 21,000 plus 70,000 is 91,000. Is that back to even? Don't we still have a $9,000 loss after 2 years? Okay. So what would we need to earn to get back to even? If we divide 30,000 that we need to get back by our $70,000 balance, it shows that we need to have a 42.9% gain just to get back to even. See, this is why I call this the power of losses. You have to understand how huge losing money is at any point in your life. So when you hear the media, your broker, anyone talking average returns, okay, you've got to be aware of the power of losses, because when average returns don't accurately portray those, okay? So in the first scenario, remember, I'm down 30% in year 1, then I'm up 30% in year 2. So what's my average return? If I'm down 30 and up 30, 30 plus, a negative 30 plus 30 is 0, right? So over 2 years, 0 divided by 2, anything divided by 0 is 0. So my average return in that scenario was a 0% average return, right? So if you heard, oh, I lucked out, I earned a 0% return over the last 2 years, what would you expect your balance to be? You expect it to be even, right? But we know that's not the case in our scenario. We went from 100,000 down to 70. We gained another 21. In that 30% gain, we're to 91,000. So my actual return, when you run the numbers through your financial calculator, was a little bit more than a 4.6%, a negative 4.6. It's a huge difference, don't you think? Only it gets worse, right? What did we forget in those calculations? Aren't we charged fees? Okay, whether we're up or down. Would it surprise you to find that the average fees inside of mutual funds, which is, face it, that's where most of us have our money in the market, okay, is more than 3%? See, Forbes and mutual fund research firm Morningstar, I believe it was in 2011, did a study, okay, and they found that the average fee structure inside of a mutual fund, when you include the disclosed fees and the hidden fees, is more than 3%, okay? So doesn't that make my losses bigger and my gains smaller? Because if I'm averaging a 3% fee, I have a guaranteed 3% loss every year. Okay, if I'm down, it compounds them, and if I'm up, it reduces my gains, right? Okay. So you know how we're told, that the market is always up over time, and that we shouldn't worry about losses when we're younger, right? Okay, so let's look at a real world example. If we assume you had $100,000 in the S&P 500 January 1st of the year 2000, and you left it there through the end of 2014, that's 15 full years. We're just looking at the S&P 500 without dividends, because look, the dividends typically average between 2 and 3%, but an average fee inside of a mutual fund is 3%, so we're just going to call that a wash. So the average return in the S&P 500 for that period was 4.07. That's not bad considering those huge losses we had from 2000 to 2002, and then again 2007 to 2009. So if you had 100 grand and it earned an average return of 4.07%, you'd expect to have a balance of $181,921. Run it on a financial calculator or Excel, or take my word for it. Okay. Do you know what the actual balance would have been at the end of 2014 if it was actually in there? It would have been $140,268. That's more than $41,000 lower than what you would have expected at a 4.07 average return. See, the actual return, money math, or compounded average growth rate, was only 2.27% due to those huge losses that we saw. So you tell me, if you expected 181 grand and got 140 grand, is that a big difference to you? Okay. Now the market mavens, the media, the government, everyone's telling you, see, I told you, over time the market's always up, right? If you had 100 grand in 2000, you have 140 grand today, you're up. Yeah, right. Let's just sing it from the rooftops. What are they forgetting? Okay. With 100 grand in 2000, in the year 2000 purchased the same amount in 2015. Okay. Didn't they forget inflation? If inflation was just 3%, that means in order to be even after 15 years, your $100,000 would need to be $155,797. That's $15,000 more than what you have. So are you up after 15 years? Are you even after 15 years? Aren't you still behind after 15 years? So the market isn't always up when you factor in real life things. Right? So how long is the average work life? 35 to 45 years? Say you work from age 25 to 70. That's 45 years. Okay, I'm doing that because it's easier for my math. If I divided 45 years by 15 years, remember this is a 15-year period and we're still not up. Okay, isn't that a third of your work life? So in this case, you spend a third of your working life and you're still behind, right? So tell me, when can you ever afford losses? I don't care how young you are. They tell you when you're young you can be risky and afford losses. I'm telling you, you can't. Okay? All right, now the average retirements last in 21 years, but it could easily last up to 30 years or longer. So imagine you entered into retirement in 2000. How do you think you'd have been doing taking money out of that losing account for all those years? All right, now I know I'm picking out bad situations, okay? And I realize that. All right, but let me ask you this. How do you know when you retire you won't do it right before a bad market or want to retire during or right after a bad market? Remember, they've averaged a 47% loss every 11 years since the year 1900. Is that how you want to build and then live your retirement? At the mercy of something you have absolutely no control of. In fact, nobody controls what happens in the market, or everyone would be rich. So if there was a no cost or obligation way where would you be open to explore some alternative strategies that would guarantee you would never lose money again and put you in a position to make sure that you take advantage of rather than be hurt by negative events in the economy? There's a lot more to it, but since we're concentrating on market losses, that's all we're going to focus on right here. But if you're open to exploring alternatives in a no cost, no obligation, no pressure situation, then we can share some other amazing benefits with you too in that meeting. So if you're open to doing this, if you're open to exploring this, call my direct line, 816-582-5532. Or you can email me. The information's up there on the screen. Or you can schedule an online smart retirement strategy session with me. And that's at that on the screen there at www.meetme.so/Kurt Jackson. You just click the smart retirement section and then the smart retirement strategy session. And then once you get in there, pick a time that's good for you, and then we can meet online. Okay? Think about it. If we're meeting online, that way if you think I'm full of it, you could fake like maybe your internet's going out and slam the laptop shut on me, and I won't know what happened, and you've gotten rid of me. So you've gotten rid of me cyberly. I made up that word. I don't think it's real. So hey, so if you're open to that, just let me know. I'll be happy to share these with you. I think you'd be amazed at what's out there that you don't know about. I want to thank you for tuning in this week. If you found value in this week's topic, please share the link with your friends, your family, your coworkers. They might find value in it too. All in all, I hope you have a great week. But I really, really hope that no matter whether you talk to me or not, that you have a very successful retirement. Talk to you next time.